Hi, Brendan here. Today is Wednesday, February 26th. I'm coming at you from sunny California, where I work as a financial advisor, and as usual, today is a beautiful day. Unfortunately, it is not a beautiful day in the markets. In fact, it's been a pretty rough week overall. On Monday, the US markets were down over 3.5%, and they followed that up with another 3% decline on Tuesday. This morning, following 4 straight down days, we experienced a little bit of a dead cat bounce. But the markets gave back all of its positive returns, and it looks like it'll finish the day in the red. If you have any questions, please comment below. I'm sure if you have a question, so do other people, so commenting will help us all. Anyway, why is this happening? Why are the markets down so much this week? At its core, markets go down for one reason and one reason only. More people are selling rather than buying. That's it. It's very simple. All market fluctuation is due to the reactions of all investors as a group. This is why sometimes the investor markets do not perform rationally. So really, to determine why markets move the way they do, you have to look at investor psychology. For large market moves, like we've experienced this week, the investor reaction can be attributed to specific news that was recently received by the general public. Uncertainty is the worst thing for market performance. Uncertainty leads to fear, and fear leads to amplified reactions. I think that's what's happening this week. Coronavirus is spreading faster than we thought it would. Infections have risen considerably in South Korea, Italy, Iran, Singapore, Japan. That's just to name a few. At the time of this recording, coronavirus cases have topped 81,000, with deaths above 2,700. The majority of the cases and deaths are in China, but the good news is that new cases are slowing in that country. So it seems that China is beginning to contain the infection in their home country. But officials have stated that coronavirus will likely become a global pandemic. This uncertainty and fear have led investors to become wary of the investment markets. As an investor, the concern is that if the average person is worried they will contract coronavirus, then they are less likely to go out to dinner or the movies or concerts because they'll want to avoid large groups of people. If enough people decide to alter their daily lives in this way, then less money is getting pumped into the economy, and some sectors could see an effect. To see this really make an economic impact, a very large number of people would have to alter their way of living for a relatively extended period of time. Another worry is in China. Efforts to prevent the spread of coronavirus have shut down factories. Many companies worldwide rely on Chinese factories to produce their goods. This can have a large global economic impact. How long this continues is largely uncertain, and this uncertainty is what the investment markets are reacting to. If new infections slow and Chinese workers return to factories in the near term, then the effect to the Chinese and the global economies would be benign. If infections continue to grow rapidly, then Chinese workers will return to factories at a very slow pace, and their recovery will start later. More supply chains will be disrupted, and the impact on global growth will be more significant. It is very difficult to determine whether coronavirus will continue to spread at a rapid pace or if it will be contained. There is a lot of uncertainty regarding the infection's incubation period, fatality rates, and forms of transmission. There is a strong possibility that it gets worse before it gets better. So how are the markets going to react going forward, and how should you position your portfolio in the best way possible? Coronavirus will not last forever. At some point, we will contain it. It appears that this containment may have already begun in China. Based on an analysis of 4 prior pandemics, SARS, H1N1, bird flu, and Ebola, treasuries tend to outperform US stock markets immediately after the start of an outbreak, but the stock markets tend to outperform in the subsequent 3 to 6 months. We are currently in the initial outbreak period, but trying to react now by selling your stocks and investing in treasuries is not prudent. The market has already taken a big hit due to this concern. But the truth is that I don't know how the markets are going to react in the coming days, weeks, and months, and no one knows. We can look at historical data to see how it's reacted in similar scenarios, but each time the markets can react differently. The only thing I am confident of is that over long periods of time, the markets will continue to increase in value, just as they have always done. There may be additional risks of downside in the near term, but it is important to stay invested and not react to short-term concerns. Long-term investors should see these dips as buying opportunities. The market is essentially on sale. Personally, I am using these market dips to add to my equity investments. I understand that the market may continue to decline, but I am a long-term investor and I don't react to news like this in my investment portfolio. I believe that global economies will rebound and continue to grow into the future. When designing your investment portfolio, you shouldn't invest in the stock markets unless you have an investment time frame of at least 5 years. If you feel like you'll need that money within 5 years, then you should invest in less risky investments, such as bonds. The stock market can be volatile, as we've seen earlier this week. There is always the chance that you will lose money, and the probability of this is much greater in shorter time frames. Historically, on a daily basis, the stock market is only positive about 53% of the time. That's just about a coin flip. Over a 15-year time period, however, the stock market is positive 97% of the time. On a short-term time basis, stock markets are very unpredictable, but over longer periods of time, they become incredibly predictable. Your asset allocation, which is the proportion of stocks and bonds in your portfolio, should be designed so that you do not feel the need to sell or change your investments when markets have sudden declines like we've just experienced. Over the last 10 years, we've had a great expansion. The markets have generally increased without much volatility. Historically, this is very unusual. 10% corrections usually happen on an annual basis, but we have not experienced this for a while. It's easy to get used to a strong bull market and believe that you should be aggressively allocated, which is to have a large portion of your portfolio in stocks. But you have to be honest with yourself and understand how you would react emotionally if your portfolio were to lose 30 or 40% of its value. As an example, say you had $100,000 invested and there was a major market correction similar to the financial crisis in 2009, and your portfolio declined by 30% or $30,000. So now it's only worth $70,000. Would you be able to handle this, or do you get too concerned and want to sell out of the market for fear that it would decline further? If your answer is you would want to sell out, then you are too aggressively allocated. You should increase your bond allocation and decrease your stocks. Your age is another major consideration when it comes to your asset allocation. If you are young, then you can afford to position your portfolio more aggressively because you have a longer investment time frame, and if there are major corrections, you have time to ride it out. You may have many years to continue earning and saving money to add to your portfolio. A more aggressive allocation based on young age is only prudent if you have the emotional fortitude not to adjust your portfolio in a market decline. As you age, your investment time frame shortens, so you have less time to ride out down markets, so you should consider decreasing the risk in your portfolio. The most important thing when investing is to stay disciplined. You cannot react to market movements, or you'll end up selling when the markets are low and buying when they're high, which is the exact opposite of what you want to do. If you stick to a specific asset allocation and rebalance your portfolio annually, then you will naturally sell towards market highs and buy towards market lows. This is because in a given year, if stock markets decline, bonds tend to go up, or at least not to decline by as much. So your relative allocation to bonds will increase. To bring your portfolio back to your target asset allocation, you'll need to sell bonds and buy stocks. The reverse is also true. If stock markets increase, then bonds will tend not to increase by as much. So a rebalance will sell stocks after they have gone up and buy bonds when they've declined or at least not increased by as much as stocks. Within your allocation, you should also be diversified globally and throughout different sectors and industries. You should have a specific target allocation for each of these areas, which you will also rebalance at least annually. Let me know what you think of this market update in the comments below. If you found it helpful, please click the like button and subscribe to my channel. Also, I'm happy to answer any questions you have, whether it's about current economic news or how to position your own portfolio. Take care and have a great day.